As we enter the second half of 2025, the U.S. economy appears to be in a Goldilocks phase. Growth has been steady, inflation's been easing, and equity markets have remained strong. But beneath the surface, risks have been building, and we think caution is warranted as we enter the back half of the year. In this update, we'll walk through three key challenges, what we're calling the three bears, that could disrupt this delicate balance. From persistent inflation and policy uncertainty to stretched market valuations, we'll explore what these risks mean for investors and how we're positioning to navigate what could be more of a challenging environment. The latest data shows that U.S. growth is cooling from the rapid pace of 2024. The Atlanta Fed GDP Now model pegs second quarter GDP growth this year up around 2.4%, a modest expansion but notably lower than earlier in the year. This moderation partly reflects the inventory drawdown and housing slump, which are now dragging on growth. Businesses built up inventories earlier in the year ahead of the anticipated Liberation Day tariffs and are now drawing down on inventories rather than reordering, which reduces GDP growth. Likewise, the housing market is gasping for air under the weight of higher interest rates, with residential investment spending contracting at 6 to 7% annualized after 3 years of a 30-year mortgage rate hovering around 7%. In a recent client quarterly letter, we warned that the U.S. faces a more challenging growth and inflation mix in the coming quarters with persistently higher interest rates. This is now playing out. Recent data like the June Consumer Price Index, or CPI, as well as retail sales, reinforce our view that the Federal Reserve will not be rushing to cut interest rates by a large magnitude in the near term. Inflation has eased only gradually and remains above target, and the economy, especially consumer spending, is proving resilient. Barring any major downside surprises in the data, we don't anticipate that the Fed rate cuts will really materialize before the end of the year, and the punch bowl of easy money is unlikely to return soon. At first glance, the labor market still looks solid. The unemployment rate is low and job gains continue. But digging deeper, signs of fatigue are starting to emerge. Most recent job growth has come from government hiring, while private sector gains have slowed sharply. Employers, having struggled to hire in recent years, are now hesitant to fire, but they're also pulling back on new hiring. This creates a labor market that is clearly cooling but not collapsing. The risk is that growth is at stall speed, where monthly gains are just barely exceeding population growth. The Fed is watching this closely as it weighs the peril of over-tightening against still elevated inflation. They face the challenge of their dual mandate, maximizing employment and maintaining stable prices. So what are they to do? Attack a slowing job market or fight off potential for higher inflation? For now, policymakers remain cautious, and so do we. Until unemployment moves meaningfully higher, we expect the Fed to take a patient approach. And that brings us to the broader picture. While the economy still feels just right on the surface, we see three key risks, three bears, that could disrupt the balance. And let's take a closer look. Encouragingly, inflation is moving in the right direction overall and pointing to disinflation. Prices are still rising, but at a slower rate. A big positive is that shelter costs, which remained elevated last year, have started to soften noticeably. In the June CPI report, shelter costs rose 0.2%, the mildest increase since early 2021, and the cooling in housing costs is exerting downward pressure on the overall level of inflation. New lease activity is also showing that rental prices are declining, so CPI shelter index should continue to moderate. At the same time, we're detecting early signs of inflationary pressures from the new tariffs that were imposed earlier in the year. Items most exposed include goods like apparel and furniture, as well as electronics, that are seeing meaningful price acceleration. These outsized monthly moves could be the start of a tariff-related cost increase passing through to consumers. So even as services inflation is easing, goods inflation is no longer as soft. We need to brace for the possibility that upcoming CPI readings will reflect further price increases on imported goods as businesses run out of pre-tariff inventory and have to start importing at a higher cost. The other aspect for this higher for longer inflation could spell higher for longer interest rates. The phrase higher for longer has basically become Fed policy. Short-term rates are at their highest in 15 years, and the Fed plans to keep them elevated well into next year. Further, the Fed does not control long-term government bond rates, which have remained high by post-2008 standards due to deficit concerns. Those higher yields are like gravity weighing on the interest-sensitive parts of the economy, and we've already seen housing, banks, and segments of the stock market feel that weight. You could say the creaking sound you hear is the economy laboring under the stress of higher interest rates. And so far, the economy has handled these higher rates, but the longer we stay higher for longer, the greater the cumulative strain. The second bear is ongoing uncertainty around tariff policy. In fact, we've had to update this chart a few times since originally putting it together. We're essentially living through a volatile trading experiment. In April, the U.S. administration dramatically raised tariffs on many imports as part of its Liberation Day announcement. Average tariff rate on U.S. imports has now jumped from low single digits last year to the mid-teens, so about 10%, with some specific tariffs even higher. Since then, we've had back and forth of negotiations and threats that could push rates higher or lower, though definitely above levels that we've seen in the last 50 years. So why does this matter so much? Tariffs act like a tax on trade or consumption. They raise import prices, which feeds into inflation, and they can hurt export demand if other countries retaliate and pressure capital investment because businesses do not know what the rules will be. Current tariffs could push core inflation, or PCE, to 3.5% to 4% by the end of the year, compared to 2.5% without them. These higher costs and disrupted supply chains may slow growth, and signs of stagflation, higher inflation from low growth emerging. Retailers have benefited from a stockpile of pre-tariff low-cost inventory, which may soon run out right as higher input costs on steel, aluminum, copper, and others come more into effect. In fact, our U.S. outlook is turning a bit stagflation-ish. Trade wars, restrictive immigration policy, and higher oil prices have collectively shifted the economy not quite towards 1970s stagflation, but uncomfortably in that direction. It's also worth noting that tariff policy is not happening in a vacuum. It ties into the broader geopolitical tensions, and when flare-ups in Iran, Israel, or Ukraine are upsetting the world order, it could contribute to that as well. The bottom line is uncertainty itself is a risk as businesses delay decisions amidst uncertainty. U.S. stocks have been on an impressive run since April, with the S&P 500 reaching new all-time highs. However, this rally has also pushed valuations to elevated levels, and the S&P 500's forward PE ratio is now back above 22 times earnings, well above historical averages. This suggests the market is priced to perfection, leaving little room for disappointment should earnings growth slow. Second quarter offers a low bar as analysts expect just 5% earnings growth, but the risk of 5 to 10% pullback is elevated, especially if the macro conditions disappoint. Compounding the risk is narrow leadership of the stock market rally, driven largely by a handful of mega-cap tech stocks, you know them and love them, the Magnificent Seven. Outside of these names, earnings growth is flat or negative, and the equal-weighted S&P 500 has significantly lagged, signaling weak market breadth. Historically, rallies with such narrow leadership can be fragile. If market darlings stumble, there's not enough strength in the rest of the market to cushion the fall. We're monitoring this really closely, as it suggests a less healthy bull market than all-time high headlines may imply. The strategy now is to stay selective, favoring quality companies with strong fundamentals and avoiding overexposure to the high-flying few. We acknowledge the asymmetry here, more downside risk than upside if Goldilocks scenario does not fully materialize. Diversification is key when market leadership is so narrow. The fixed income side of the market also presents a valuation conundrum, albeit much of a different flavor. Yields are broadly higher than where they were a year or two ago, which is good news for you investors seeking income, but credit spreads, or that extra yield for corporate bonds above treasuries, have become very tight by historical standards. These tight spreads indicate a lot of investor confidence, perhaps too much, that corporate defaults will remain low and will not need to be compensated for big credit risk. On the other hand, investment-grade bonds and treasuries support a yield to worst of nearly 5%. So in pure income terms, pretty appealing. These are the highest bond yields we've seen in over a decade. The catch is the extra cushion for credit risk is really thin. We look to add value in the highest quality below investment-grade bonds, especially those with shorter maturities, which offer an attractive yield over 6% without excessive risk. These issuers often have good balance sheets, limited upcoming maturities, solid fundamentals, and offer better compensation than borderline investment-grade names. The fixed income stance is a barbell. Favor high-quality investment-grade names for stability and select high yield for income while avoiding the riskiest corners of the market. In summary, our outlook acknowledges that on the surface, things might still feel somewhat Goldilocks. Unemployment is low, inflation's off its highs, and the economy is growing modestly. But under the surface, these three bears are prowling: lingering inflation, higher rates threatening to slow the economy further, unpredictable trade policy that could deliver stagflationary pressures, and market valuations that may have gotten ahead of fundamentals. As stewards of your investments, we're positioning defensively, yet proactively, staying diversified, focusing on quality assets, and looking for opportunities where compensation for risk is adequate, and avoiding areas where the story looks too good to be true. The goal is to protect the downside while also being able to participate in the upside if this Goldilocks environment continues to persist. In fairy tales, Goldilocks gets the flea when the three bears return. In the real world, we have to face these risks head on. By keeping these risks in focus, we ensure that your portfolio can withstand whatever twists that the second half may bring. Thanks for tuning in. We look forward to staying in touch and keeping you updated throughout the quarter.